The Federal Reserve just held interest rates frozen for the third meeting in a row, and markets are now pricing in zero cuts for the rest of 2026. Your 30-year mortgage is sitting at 6.5% right now. Your new car loan is averaging nearly 7%. And the Fed just told you, officially, that relief is not coming this year. This affects your money, today, right now. I want you to meet Marcus. He is 34 years old and works as a project manager in Columbus, Ohio. He has been watching mortgage rates for 2 years, waiting for them to drop so he could finally buy a home for his family. At the start of 2026, he thought this was going to be his year. Rates had come down from 7% in 2025. He could almost see the finish line. Then, on April 29th, the Federal Open Market Committee, the group inside the Federal Reserve that actually sets interest rates, voted 8-4 to hold the federal funds rate right where it is, in a range between 3.5 and 3.75%. That was the third consecutive meeting with no change. And 3 members dissented not because they wanted to cut, but because they believe rates may need to stay elevated even longer than anyone expected. The last time 4 members dissented like this was October 1992. The reason the Fed is holding is that inflation is still elevated. Oil prices have surged more than 76% since early spring. Conflict in the Middle East is pushing energy costs higher, and the Fed knows that higher energy costs feed into the price of almost everything you buy. Their 2% inflation target feels farther away, not closer. Just a reminder, this is not financial advice. Everything here is for educational purposes only. Always speak with a licensed financial advisor for your specific situation. Most people hear the Fed held rates and think nothing changed for them. But here is the reality. There are 3 things you need to understand about this, and the third one is the one most people miss completely. The first is what this freeze is doing to your mortgage right now, and the number is going to stop you cold. The average 30-year fixed mortgage rate is sitting at 6.5% as of mid-May 2026. On a $300,000 home loan at 6.5%, you are paying roughly $1,896 a month in principal and interest. At 3%, where rates were just 4 years ago, that same loan cost $1,265 a month. That is $631 more every single month. Over 30 years, that is more than $227,000 in extra interest. That is more than most Americans have saved for retirement. The reason rates are not falling is that they track the 10-year Treasury, not the Fed funds rate. And inflation is keeping bond investors on edge. What can you do right now? Go to consumerfinancial.gov, that is the Consumer Financial Protection Bureau, and use their free mortgage shopping worksheet to compare lenders side by side. Research shows that borrowers who get at least 3 quotes save thousands of dollars over the life of their loan. Shopping around is not optional right now. It is one of the most direct ways to control your costs in this environment. But your mortgage is only part of the story, because point 2 is where things get serious. Right now, the average interest rate on a 60-month new car loan is 6.97%, according to Bankrate's survey from May 13, 2026. Used car rates are often above 7%. The average new car in America costs around $48,000. At 6.97% over 60 months, you are paying close to $950 a month. And over the life of the loan, nearly $9,000 in interest alone. That is more than most American families spend on groceries in an entire year. For a car that will be worth a fraction of that price in 5 years. The trap most people fall into is taking dealer financing without shopping first. Dealer financing often carries a markup that goes right back to the dealership. Before you walk into any showroom, get a pre-approval from a credit union. Go to mycreditunion.gov, that is run by the National Credit Union Administration, and find a credit union near you. Credit unions routinely offer car loan rates significantly lower than dealer-arranged financing. Walking in pre-approved means you are in control. If you are watching this and you have not subscribed yet, please do that right now. I put out videos every week to help you understand exactly what is happening to your money. Now we get to point 3, the one most people miss. And this one is actually good news hiding inside a bad situation. The national average savings account rate at a traditional bank is just 0.38 to 0.60% APY right now. At 0.38%, $10,000 in savings earns you about $38 over an entire year. That is less than a single dinner out. But high-yield savings accounts at online banks are still paying around 4 to 4.1% APY because the Fed has kept rates elevated. That same $10,000 earns roughly $408 a year. Both accounts are FDIC insured up to $250,000. 10 times the return with 0 additional risk. You can compare the best high-yield savings accounts right now at nerdwallet.com or bankrate.com. Many of the top accounts have no fees and no minimum balance requirements. Moving your emergency fund from a traditional savings account to a high-yield account is one of the simplest financial moves you can make. And in a frozen rate environment like this one, every month you wait is money you are leaving on the table. That is the third point most people never connect to a Fed decision. Now here is my honest take on all of this. The Fed is not your enemy, but sitting still and waiting for rates to fall before you do anything, that is what hurts you. Markets are pricing in 0 cuts for the rest of 2026. Here are 5 specific things I would do right now. Move your emergency fund to a high-yield savings account today at nerdwallet.com or bankrate.com. Get pre-approved at multiple lenders before you buy a home by using the free tool at consumerfinancial.gov. Get a credit union pre-approval for your next car at mycreditunion.gov before you walk into any dealership. Lock in a CD above 4% APY now if you have money you will not need for 6 to 18 months, because when the Fed eventually cuts, those rates drop fast. And if you are carrying high-interest credit card debt at 20% or above, call your card issuer and ask for a rate reduction. Or look into a balance transfer card using the comparison tool at consumerfinancial.gov. Each of these actions is something you can take this week. None of them require you to wait on the Fed. The people who act on this information today will be in a completely different financial position than the people who wait. Here is where we stand. The Fed just held rates frozen for the 3rd meeting in a row, and markets expect no cuts through 2026. Your mortgage and car loan costs are significantly higher than they need to be if you are not shopping around and using pre-approvals. And most Americans are leaving real money behind by keeping savings in low-rate accounts when high-yield accounts paying 10 times more are 1 click away. If this video helped you understand something important about your money today, please subscribe. I put out new videos every Tuesday, Thursday, and Saturday. And remember, knowledge is your greatest asset. In my next video, I am covering what the latest inflation numbers at 3.8% actually mean for your household budget. And trust me, you will not want to miss that one.